But the right question wasn't who has the best product. It was, which platform can withstand the next cycle without becoming a budget bankruptcy within companies? In September 2020, Snowflake went public on the New York Stock Exchange in the largest software IPO in history up to that point. The shares had been priced at $120. They opened at $245. By the end of the first day of trading, the company was worth more than $33 billion, a figure that, for a software business that had existed for 8 years and had never turned a profit, required a specific set of conditions to be legible. Those conditions existed in abundance in September 2020. Warren Buffett's Berkshire Hathaway bought shares at the IPO price, the first time the firm had participated in a primary IPO in decades. Salesforce invested. The institutional appetite for the offering was extraordinary. Snowflake had built something that enterprises genuinely needed. Its cloud-based data warehouse allowed companies to store, query, and analyze vast data sets without managing the underlying infrastructure themselves. It separated storage from compute in a way that its predecessors, on-premise data warehouses built around Oracle and IBM technologies, had never done. The product was fast, scalable, and, by the standards of enterprise software, elegant. The customers who used it tended to expand their usage substantially over time. The net revenue retention rate, which measures how much existing customers spend year over year, was consistently among the highest in enterprise software. The IPO price reflected all of that. And then some. At roughly the same moment, in the office buildings of San Francisco, a company called Databricks was working on a problem it believed Snowflake was not solving correctly. Databricks had been founded in 2013 by the researchers at UC Berkeley who had created Apache Spark, the open-source distributed computing framework that had become the backbone of large-scale data processing at companies ranging from Netflix to Uber. The company's founders understood data infrastructure at an architectural level that few commercial software teams could match. And by 2020, they had reached a conclusion about where the data industry was heading that placed them on a direct collision course with the company that had just executed the largest software IPO in history. The conclusion was this: the future of data infrastructure was not a proprietary cloud warehouse. It was an open, unified architecture that combined the analytical power of a data warehouse with the flexibility of a data lake, storing data in open formats on cloud storage that no single vendor controlled, and allowing any tool, any query engine, and any machine learning framework to operate against it directly. Databricks called this architecture the Lakehouse. The format it had built to enable it was called Delta Lake, open-sourced in 2019. The principle was interoperability. Data stored in Delta Lake could be read by any compatible engine without requiring the data to be copied, converted, or locked into a vendor-specific format. For enterprises managing petabytes of data across multiple cloud providers, the practical implication was significant. A Lakehouse architecture meant that a company's data belonged to the company, not to the platform it happened to be stored on. Snowflake's architecture worked differently. Its data warehouse stored data in a proprietary format on infrastructure Snowflake controlled. Moving data out of Snowflake required export processes. Querying Snowflake data from external tools required specific integrations. The performance and reliability of the Snowflake platform were exceptional, and enterprise customers paid substantially for both. But the architectural model meant that choosing Snowflake also meant, to a meaningful degree, choosing Snowflake's ecosystem, accepting a dependency on a single vendor's roadmap, pricing, and product decisions. In 2020, this trade-off was widely understood and widely accepted. Snowflake's net revenue retention rates above 150% made the dependency look less like a trap than a partnership. Customers expanded their Snowflake usage aggressively because the product kept delivering. The proprietary architecture was the foundation of the product's performance. The lock-in was, from the customer's perspective, often a feature rather than a bug. It meant a consistent, optimized experience that loosely coupled architectures could not always match. But 2020 was also the year when a different set of technical requirements was beginning to emerge in enterprise data infrastructure. Machine learning workloads, the training of predictive models, the pre-processing of unstructured data, the building of AI systems, required data to live in formats that Snowflake's architecture was not designed to serve efficiently. Training a large model required reading enormous volumes of data directly from cloud storage in formats optimized for batch processing, using frameworks like TensorFlow or PyTorch. That data lived in data lakes, not data warehouses. The pipeline between a Snowflake warehouse and a machine learning training job was friction that Databricks, with its Lakehouse architecture, had been designed to eliminate. The question of which architectural bet would define the next decade of enterprise data infrastructure was, in 2020, genuinely open. It was not obvious that machine learning would become the dominant workload in enterprise data stacks. It was not obvious that the performance premium of Snowflake's proprietary architecture would eventually be eroded by improvements in open table formats. And it was not obvious that the open source community would coalesce around a single interoperability standard fast enough to challenge a platform with Snowflake's customer relationships and net revenue retention. Snowflake's leadership read those uncertainties and concluded that the proprietary model remained the correct bet. The company continued to invest in its warehouse architecture, its performance optimization, and its ecosystem of integrations. It had the capital. The IPO had raised more than $3 billion. And it had the customer momentum. The decision not to build around open formats, not to position itself as a neutral participant in an open ecosystem, was not an oversight. It was a deliberate strategic posture, maintained consistently over several years, by a management team that had built one of the most successful enterprise software businesses in history. Frank Slootman, who had been recruited as Snowflake's CEO in 2019 before the IPO and had presided over the company's extraordinary growth, embodied that posture. Slootman was one of the most respected executives in enterprise software. He had taken two previous companies, ServiceNow and Data Domain, through successful trajectories that rewarded conviction, speed, and competitive aggression over accommodation of open-source competitors. His playbook was to build the best product, charge for it accordingly, and outrun the alternatives. The Snowflake IPO had validated that playbook at a scale that made the September 2020 valuation look, to many observers, not just reasonable, but prescient. Databricks during this same period was a private company with a fraction of Snowflake's market visibility. Its 2021 valuation was $6 billion, less than a fifth of Snowflake's market capitalization at the time. It was growing fast, but its revenue was substantially smaller. The Lakehouse thesis was compelling to engineers and data scientists who understood the architectural argument. It was less immediately legible to enterprise procurement teams who were evaluating software on the basis of performance benchmarks, support contracts, and integration breadth. The race was not yet decided, but the architectural divergence was becoming permanent. The moment that began to shift the balance was not a product launch or a competitive benchmark. It was a category definition. In 2022 and accelerating through 2023, the phrase generative AI moved from research papers into enterprise procurement conversations. The large language model architectures that had been developing in academic and corporate research settings became commercially viable at a speed that enterprise software roadmaps had not anticipated. Companies that had been planning multi-year data infrastructure migrations suddenly found themselves with an immediate question. Could their data stack support AI workloads? For Snowflake's enterprise customers, the answer required careful examination. The data they needed to train, fine-tune, or run inference on AI models lived, in many cases, in Snowflake's proprietary warehouse format. Moving it to the environments where AI training happened, GPU clusters running open-source frameworks, required export, transformation, and integration work that added latency and cost to every iteration. The proprietary architecture that had delivered exceptional performance for structured analytical queries was not the architecture that AI workloads were designed around. Databricks had built the Lakehouse precisely because its founders had anticipated that data engineering and machine learning would eventually converge on a single infrastructure layer. When generative AI made that convergence urgent rather than theoretical, Databricks was positioned at the intersection in a way that Snowflake was not. Data stored in Delta Lake format on open cloud storage could feed AI training pipelines directly, without conversion or export. The Lakehouse architecture was not just an analytical platform. It was, by 2023, increasingly recognized as the most natural substrate for AI-native enterprise applications. Databricks moved to accelerate that positioning. In June 2023, the company announced the acquisition of MosaicML, a startup that had built efficient large language model training infrastructure, for approximately $1.3 billion. The acquisition was direct and deliberate. Databricks was purchasing the capability to train and fine-tune large models on its own platform, using its customers' data, in the open Lakehouse format it had championed. The message to enterprise customers was clear. On Databricks, your data and your AI models lived in the same architecture, governed by the same open formats, without requiring your data to leave the environment you already controlled. Snowflake's response was a recognition that the open format argument had moved from a competitive talking point to a genuine customer requirement. The company had resisted deep integration with Apache Iceberg, the open table format that, alongside Delta Lake, had become the other major interoperability standard for Lakehouse architectures. During the years when its proprietary model was delivering superior performance and customer satisfaction, by 2023, that resistance had become strategically untenable. Enterprise customers were explicitly asking for Iceberg support. The competitive differentiation of proprietary formats was eroding as open formats matured. Snowflake announced expanded Iceberg support, reframing it as a feature rather than a concession. The reframing was technically accurate but strategically revealing. The company that had been built on the premise that proprietary architecture was the foundation of differentiated performance was now signaling that open formats were compatible with its platform. The signal was received by enterprise architects who had been evaluating the two platforms against each other. Open format support from Snowflake confirmed that the Lakehouse thesis had won the architectural argument. It also confirmed that Snowflake had been on the wrong side of that argument for longer than its public positioning had suggested. The market's reading of this period was visible in Snowflake's stock price. The company had peaked at approximately $390 per share in November 2021, giving it a market capitalization above $100 billion. By early 2024, the stock had compressed to roughly $150 to $170. A reduction of more than half from the peak, even as the company continued to post strong revenue growth. The compression was not explained by deteriorating financial performance. Revenue was growing, customer counts were expanding. The net revenue retention rate remained at levels that most enterprise software companies would regard as extraordinary. The compression was a market assessment of competitive positioning. Investors who had priced Snowflake at a $100 billion valuation in 2021 had been pricing a company they believed would be the dominant, defensible platform for enterprise data infrastructure across the next decade. The AI era had introduced a variable that the 2021 pricing had not adequately weighted: the possibility that the architectural choices underpinning Snowflake's differentiation would face a structural challenge from a competitor who had built around open standards from the beginning. That assessment was made concrete on February 28, 2024. When Snowflake announced that Frank Slootman was retiring as CEO. The stock fell more than 20% on the day of the announcement. Slootman was replaced by Sridhar Ramaswamy, who had led Google's advertising technology division and had more recently run Neeva, an AI-native search startup that Google had competed against. Ramaswamy's background was in AI product development, not enterprise data warehouse operations. The choice of successor was itself a strategic communication. Snowflake was signaling that its next chapter required a different kind of leadership, one oriented toward AI product development rather than the enterprise sales machine that Slootman had built. The company that Slootman had taken public in 2020 on the strength of its data warehousing capability was now explicitly reorienting toward an AI platform identity. The product launches that followed under Ramaswamy, Cortex AI, Snowpark for Python, expanded Iceberg support, and eventually Snowflake Intelligence, reflected the urgency of that reorientation. This was the decision that cost billions, not a single moment, but the accumulated weight of a strategic posture. The sustained defense of proprietary architecture during the years when the open standard movement was building the foundation of the AI era, that required a CEO transition to formally reverse. Databricks in the same period was building the other side of that inflection. The company's revenue had grown from approximately $1 billion in 2021 to more than $5 billion in annualized run rate by early 2026. a compound growth rate that placed it among the fastest-growing enterprise software companies ever recorded. In February 2026, Databricks announced it had exceeded a $5.4 billion revenue run rate, growing more than 65% year-over-year, and was completing a financing round of more than $7 billion at a valuation of $134 billion. The investors in that round included Microsoft, JP Morgan Chase, Goldman Sachs, Morgan Stanley, the Qatar Investment Authority, and others. A roster that reflected not just financial conviction, but strategic alignment from institutions whose enterprise clients were asking the same architectural questions. The $134 billion valuation placed Databricks, a private company that had declined to go public despite years of speculation about an IPO, at a figure that dwarfed Snowflake's current public market capitalization of approximately $60 to $70 billion. The two companies that had begun 2020 as competitors in the same general space, enterprise data infrastructure, had by early 2026 diverged in valuation trajectory in a way that reflected the market's reading of which architectural bet had been correct. Snowflake's position in early 2026 was not one of collapse. The Q4 fiscal 2026 results reported on February 25, 2026, showed product revenue of $1.23 billion, up 30% year-over-year. Remaining performance obligations, committed future revenue, totaled $9.77 billion, up 42%. The company had signed 7 nine-figure contracts in the fiscal year, compared to 2 the prior year. Net revenue retention remained at 125%. Ramaswamy described the company as being at the center of the enterprise AI revolution. The description was aspirational and operationally grounded simultaneously. Snowflake had the customer relationships, the enterprise sales infrastructure, and the financial scale to participate in the AI era. The question that the market had been pricing since 2022 was whether it would participate from the center or from the